Okay. Hello, everyone. Good morning to everyone in the U.S. and good evening and other times to people in other places. So we're kicking off our our Zoom session. We've had several of these at the Financial Profit, and uh, I've gotten quite a few requests recently to launch another session to discuss CCDs and other general questions regarding markets and perhaps some elements of the portfolio. So here we are. I hope you guys can hear me well. It seems that everything is working here. We are recording for everyone who can't make it to the Zoom session now. They can watch later. Okay, great. So I see some notes here in the chat that everything seems to be working. Okay, excellent. So let's not waste too much time. Let's get started. And so for anyone who has a question, we can just kick it off with that. So who wants to start?
Hi, good
Yeah,
morning.
okay. So I see David here.
Yeah.
David,
So
did you want to ask something? Did you want to start off our conversation today?
yeah, I think my first. So I'm not going to ask too many questions, but I'm new in this area,
Oh,
and I think it's a lot of people actually in the same situation like me, which just recently started with covered calls.
mhm.
So this is my. So you using actually a lot of abbreviations in the chat. So and it's new for me, for us. So when you so my main question. So I understand when you're doing covered call, but my question about repurchasing,
Yes.
what is it, right? I'm not sure how to do it, and I don't understand what is it. This is my first question. And second question, sometimes I see you using word hedging, okay? So hedge.
Yes.
So if you actually also explain what it means for covered calls.
Okay.
Okay,
Sure. These
thanks.
are excellent questions, David. So first, let me try to tackle the second part of the question first. So you said that I use the word hedging sometimes, and the reasoning behind this is that the covered call strategy, it's mainly a hedging strategy in my view. So basically, that's where that comes from. So to me, it's more or less synonymous with with the covered call strategy in general, uh, just to hedge, to sell calls, to do the CCD strategy is in a sense to hedge because we're basically hedging our stock positions via the CCD strategy. And I also want to maybe clarify some of the abbreviations as you pointed out. So first, I want to just say that I've been implementing the covered call strategy for about 18 years now. It's crazy how time flies, but that's in reality that's how long it's been. So to me, it's like second nature. So it I really see it fitting well into any investment into any investment strategy. It's good for extra income, extra yield as a hedge, and so on. Um, and then you also asked about okay, so I'm sorry, let's back up a little bit to the abbreviation. the CCD stands for the covered call dividends, and when in group chat, when I send out an alert about a new covered call being instrumented, basically the first of course it's the stock that it's on, then it's the percentage of the position that I'm doing the covered call on, because usually we don't do like the whole 100% position, because typically on most positions we want to leave part of the position unhedged without the covered call, or at least I do, because I want to give at least part of the position the potential to move up without the covered call. And again, that's where like the hedging portion comes in. Then it goes the expiration date. Like right now, we're typically doing the 4/19/24 expiration date. Then it goes the strike price, and basically and that's the strike price that we're doing. I abbreviate that with SP, and then the last number is the P, the premium that we're getting for the sale of the covered call option. And now to address your main question, the repurchasing. Now many people overlook the fact that a huge part of the covered call strategy is not to just let just sell the calls and leave them alone and let them expire. Of course, we could do this, but this is more of a passive covered call. I almost want to say boring. I'll say it. This is the traditional passive, boring way of doing the covered call strategy, of just kind of selling the call and leaving it and forgetting about it. And then if it gets exercised, it gets exercised. And then if not, it doesn't. But that's not how I do it, of course, because the real trick, it's in the silver lining, I guess. It's in the repurchasing of the calls, because again, we have, like, say we have an option, we can use Nvidia, for instance. So we have an Nvidia position, right? So we've seen it skyrocket. I'm just gonna do a rough example. We've seen it skyrocket to like $900. Now we go ahead and put like 50% in a 50% of the position under covered call for $1,000 strike price. Great. We get like whatever our 5 to 10% covered call dividend. Excellent. But we're really playing the short-term momentum here of the stock. Now we're counting on the stock correcting a bit. So say Nvidia moves up to 900, then it corrects to around 800 or 750. Here we really have no interest in leaving the covered call on. We have it's much better here to repurchase the covered call, because most likely we're going to repurchase for at least a 50% profitability or more. So we could basically repurchase many stocks here for pennies, or I'm referring to the covered call options on the stocks for pennies on the dollar. So say we sold the Nvidia covered call for 50 when it was at 900. When Nvidia drops down to 800, that covered call is going to be, it's not going to be 50 anymore. It's going to be like $20, maybe less. So here it makes more sense to repurchase. We get to keep the profit, the $30 difference in the premium. So we pocket that, and now we have the stock unhedged without the covered call, and likely the correction is over and Nvidia is going to go back up. So we get the best of both worlds. We collect a premium, and we have our shares free to do whatever we want with. We can either keep them long, we can do a different covered call for a higher premium. So we have freedom at this point, and that's what we like. That's what we want. We get to pocket our profit, and we have the freedom to do what we want with our Nvidia or whatever stock we have the covered call on.
Victor, can I ask a question?
Yes, of course. And David, I hope that covers your question. If not, or if you have a follow-up, just we can get back to that in a little bit. Yes, Nash, go ahead.
First of all, sometimes you have a let's say an AMD where you had a very even SAU and the $5 call where it's very in the money. You would
Yeah.
just let it run. Why wouldn't you rather close out the position and because of cost of capital? Meaning to say is the cost of waiting, which is never we know it's going to be. I mean SAU maybe not, but the AMD when it was at 150, we knew it's going to be taken away. We might as well just close out the position and take their money to put it back to work because technically it's dead money now. The same would be for SMCI or SMCI not necessarily because the 950 strike price we might see back very quickly. But sometimes it's so in the money, it just makes sense just to bring it just to close out the position. And the other question is when do you use a partial sell and when wouldn't you use a partial sell? Meaning to say is a lot of times instead of taking a CCD, it wouldn't sometimes make sense more to take a partial sell rather than the CCD.
Yes. Okay. So excellent questions. Of course, and it's it's all basically stock specific here. It depends on the risk reward ratio, on exactly how risky a stock position may be. In the SOU in the SoundHound case, basically I had the position broken down into three separate positions, and it was quite large for such a risky position in my portfolio. I don't typically have many stocks that kind of small cap risky. The risk reward is high, of course, but still it was something like at 4 or 5% of portfolio holdings. So I basically broke down the position into three. So 1/3 I did the covered call on right away, basically, and it was the $5 one that you mentioned, and I believe the premium was, if we count the upside potential in the stock, it was at least 20%. So I mean, I'll take that. I'll take that any day. Just a quick 20% profit. That's excellent in my view. And of course,
wouldn't you close out that position? Wouldn't you close out the position now?
you mean buy back the covered call and then just sell out the position?
Yes. And the
Um,
reason for that is because it gives you another percent in cash, which
right.
could be put to use instead of just waiting around.
You know, you make a valid case. Honestly, this is more of a habit thing for me. I've never done that in the past. In all of my I've never taken that viewpoint, which may seem strange, but we are creatures of habit. So honestly,
No, because I've seen it in AMD, and I've seen it a couple of times in the portfolio where I was wondering.
you
Now my problem was sometimes I didn't have actually the CCD on, and I was running way ahead, and then I trimmed the position. But my thinking was there's a cost of capital over it.
right. Yeah, I mean, that's a valid point. But again, it's it it's a thing of habit, I guess. And once again, I've never done that. So I've never actually, once a covered call goes, once it's in the money, and I just I've never taken that route because um once once it looks like the shares are going to get, could get exercised, I've always left it on and just let it just let it expire. So I've never actually, it's difficult for me to tackle this question because I've never actually taken this viewpoint that you have, but from it's something that I need to consider and maybe look at more, because in a way it does make sense, if I try to look at it from that perspective. But again, it's just the way that I do things, and my habit is that if a stock looks like it's going to get, if it looks like a position is going to get exercised, I just let it run its course. And this is one of the reasons why I don't, I always do the CCDs, like 2 to 6 weeks typically. Like sometimes, it goes as far as 8, but usually like never beyond that. So it's not like I have the position locked up for that long. And also, much of the time I end up repurchasing the CCDs. So it's like it's just something that I've never really considered, and I haven't looked at it from that perspective. But I appreciate you bringing that up, and that's something that I will definitely look at and consider more in the future, because it makes sense from a different standpoint, and I like that. So I will consider that in the future. Yes.
You appreciate it. And now, if I may ask another question, I'll leave the floor open for everybody else.
Yes,
Sorry about
you had a two-part.
Yeah. So my other question is, how does your view shift from, let's say, currently you're very bullish, and you were very bullish for the whole 2023, which was very, which made us a lot of money. No complaining about it over here. What mean says what are the parameters which make you change your view on the market? Is it just on a technical basis? And basically, how much cash are you ready to carry when you don't like the market? And if not, what's the strategy from where does it change from bullish AI to say, you know what, it starts making sense to change over the whole strategy? I mean, not strategy, whatever. What's the decision making, and how do you position the portfolio? Because I've seen we started the quarter with 57% in tech. Currently, we're only 44. Basically, what it does is I loved it because we went into other positions which aren't correlated with tech. So I'm just curious, how does the bull change, and where would you take it?
Okay, excellent question. So I think it's definitely a combination of factors. So we're looking at technicals, we're looking at fundamentals, we're looking at psychological factors in the market. We have to consider all of these, and of course, another big element is intuition. I've been involved in trading and investing since I was just 20 years old, and I'm more than double that now. So I have some experience. Of course, other people have more experience, so some have less. But I've gained some experience over the years, and this experience has enabled kind of an intuition when it comes to things. So that's also a big factor. Probably, maybe the most significant fundamental factor that that may get overlooked by other market participants is the Federal Reserve, and trying to look ahead a little bit at what they're going to do, because markets very much pivot off the Fed and what the Fed is going to do, but not what the Fed is going to do like in a month or two from now, but more of like what the Fed is going to do in 6 months to a year from now, because the market really looks ahead in that respect. And since we see kind of we see an easing monetary policy ahead, then we remain bullish, or I remain bullish. And of course, we're going to have corrections, and I think the market has come up probably a bit too much on AI expectations. And of course, AI is very hot and there's, you know, just considerable potential, incredible potential. Call it what you want, but it's not something that should enable stocks to, like, you know, I'll just some examples like SMCI and others. You know, some of these market caps have gone from like 15 billion to like 55 billion or more in like a relatively short time frame. So I mean, this of course is a little bit irrational, and we see some of this, you know, some of these irrational movements. So in some respects, like parts of the market gets ahead of itself, like, you know, like the AI segment maybe now is getting a little bit ahead of itself in the short term, but not in the intermediate and long term. So that's why I am, you know, lately I've been kind of looking for pullbacks and corrections, and we've been getting them in some of the big names, and I think we can continue to see these kinds of rolling corrections. And this is another reason why we've pivoted a little bit away from tech and into some safer haven sectors, some more, you know, we've increased positions in healthcare and materials, and in other places, you know, that are not as much correlated with tech, because in the near term, some of the tech appears overbought, and I'm keen on making, you know, on making some adjustments in the peaks and during like the intermediate or short term peaks and troughs in the market, because that's really how you improve your portfolio performance, is by adjusting around the peaks and troughs. I think that's very important. That's a factor that gets overlooked a lot by many investors and money managers, in my view, is they don't put enough emphasis on adjusting around the peaks and troughs. That's really what boosts the performance in your portfolio. So we need to be very vigilant of these areas. So we trim some, you know, we take some profits from the real high flyers, we rotate into some of the underappreciated stocks like Tesla right now. And I see that, you know, there's a question from David in the chat about Tesla, buy, sell, or hold. I think Tesla it's a buy at these levels. Anything below like 180, 170, 180, I think that puts Tesla in a strong buy position, especially if we're looking longer term, intermediate and long term. Of course, in the short term, we can see more volatility in Tesla, and it's almost impossible to predict what the market is going to do in the very short term with some stocks, but we can get a much better gauge intermediate and long term.
Victor, yeah, I'm sorry, go ahead.
No, you go ahead. I was just going to ask Nesh if I covered his questions, but I think I did, and if not, Nesh can come back.
Oh, yeah, you did it very nicely. I appreciate it very much.
You're welcome.
So Victor, can you share with us a little bit of your strategy on selling puts as a means of acquiring stocks? I've actually been fortunate and had some level of success with that. In fact, did that with SMCI and MicroStrategy. And so what is your strategy, or what would be the guidance that you would give us going forward for also selling puts as a key part of building out your portfolio?
Yeah, that's a great question, Linda. Thank you for that. So first I want to address the fact that I don't cover this strategy in our all-weather portfolio. And the reason for that is because I just think it would get too complicated. It's already pretty diverse, and we have the CCDs in there, and we have collar play options for like extreme case scenarios that you know, typically I implement those in like a broad market correction or in a bear market. We were quite successful with those. Collar plays, they're more aggressive hedges in my view. So that's the reason why I don't cover the wheel strategies. Is another name for the selling put strategy. I don't cover that because it would make things too complicated, and I don't want to, you know, pile on what we have already. Now in my personal accounts and in my personal life, I do implement this strategy. It is an excellent strategy. It's very basic. So if we have like, you know, stock ABC or whatever, we can use Palantir as an example. So Palantir trades at around $24 now, 24, 25 range. Actually, it's below that. It dropped below 24 here. So great, excellent. Let's use Palantir's example. So let me do this in real time. So we have Palantir put options, 419. We have the 23 put selling at about $1.10 now. We have the 22 put selling at around 73 cents now, something like that. So I would look at these. So I would consider selling the 23 or the $22 put in Palantir here, because we are very bullish on Palantir long term. So of course we would not mind buying this stock or buying more of the stock at a lower price, at a lower buying level. Now, if we go lower than that, the premiums, they're really not that attractive. So we want to get a good premium. We want to get like something, you know, like 4 or 5% or possibly better if we can. But you know, if we get like a 3 or 2%, that will be okay in some cases also. But we really want to shoot for that like 4 or 5% range. That's probably ideal on most of the put options that we're selling.
And just as a follow-up on that too,
Yes.
because you know, there's obviously timing, and what I've tried to do, I tend to look more at the weeklies versus further out. And I know when you were talking about the covered calls, you had indicated maybe 4 to 6 weeks out. Kind of what is your thinking versus
I mean, that's
weeklies
fine.
versus 4 to 6?
Sure. That's really just you know, like a personal preference. And of course we want to be aware of the, you know, of the volume on some of the options and the spreads between the bid and the ask. We don't, you know, we don't want to deal with options that are not liquid enough, or you know, that may have issues you know, when we want to you know, close out our position or whatever. Basically with the weeklies, we just want to be careful that, you know, we are dealing with high enough volume options. That's basically it.
Okay, great.
I have no problem
Thank you.
with the weeklies.
Thanks so much.
Yep, you're welcome. Okay.
Victor, maybe you know, maybe I'll ask some questions. So
Yeah, go ahead. Why not?
you know, I just follow up with you know, previous folks. I think talk about, you know, when you make market adjustment. Can you? I mean, I saw you make some fantastic trade in, you know, 2022, right? When the market, you know, has a little bit breakdown. But I guess just question is like, how do you hold yourself like not buying, you know, crypto or you know, big tech names, you know, all the way, you know, from the 2022 period, like when I think that the time you get neutral on those names seems reasonable, right? You know, Fed is high, you know, reverse, you know, QE, and so as soon as you identify the market tops, you kind of get out. But you know, how did you manage to figure out where is the bottom for those? Like, you know, do you mind, if you don't mind, you know, walk through a little bit, because I joined pretty late, so I didn't go through the whole stretch of the 2022 period when you make those decisions. Like, what kind of thing that you make, you know, calls on those periods? You know, if you don't mind, it's kind of follow up with the question. Yeah.
That's an excellent question. So first, of course, we want to identify a possible intermediate or long-term peak in the market, and I think we did a pretty good job at identifying it. And in late 2021, we had just you know, crazy price action in Nvidia and in many other stocks. And Tesla was one of like the crazy stocks then too. I love Tesla. It's my favorite company in the world and has been, you know, for over 10 years now. But you know, at that period, you know, you can love companies, but I would not fall in love with stocks, especially when you see like really crazy irrational price action like we saw back then. It was in late 2021, and I put out an article. I think it was called something like it was a very popular article. It had like very many views. It was called, I think it was called the crash. The It was called something like um something about an epic crash coming, basically. And it was pretty specific in why it was going to happen, and you know, and it mentioned the blow off top. So of course there's the technical element when we witnessed just like irrational crazy up moves in stocks like Nvidia, Tesla, and others. Then we had technical blow off tops in those stocks, and this was also all supported with fundamental factors that you know, the stocks were just crazy overpriced. You know, Nvidia wasn't like Nvidia is now, where it's trading at like 30 times earnings or whatever, or forward earnings. It was trading at like, I don't remember honestly, but it was much different than it is now. So we had the technicals, the fundamental factors in the stocks, and we also had the really crucial factor of the Fed beginning to tighten, as opposed to you know, so we were in reverse back then. So we're basically around the top of the interest rate cycle now, and we were around the bottom then. So we were like at zero rates going into tightening, as opposed to, you know, like right now where we're at over 5% going into easing. So we were looking at tighter monetary conditions coming up. We were also looking at a macroeconomic slowdown, so that would affect earnings. We were also looking at stocks being sky high multiples, so of course those multiples would no longer be supported by future earnings that were growing, because earnings would likely decline. So it was a combination of all these factors, like technicals, fundamentals on the stock side, fundamentals on the side of you know, of the macro economy, and the Fed, all pointing to a really unfavorable scenario for stocks. So of course, you know, the cash position, and this is of course, I remembered part of Nash's question about the cash position. So I moved much of the portfolio into cash. Then it went like, you know, 30% or more into cash at some points. We also instituted, of course, CCDs and plus collar hedges on many of our positions to increase income and to limit drawdown. And then we did some trading around the peaks and troughs a little bit. Like we can tell technically when the market reaches like a near term bottom, even within like a bear market like we had in 2022. So we made some profitability then. Of course, it's never perfect, and you're not going to get them right 100% of the time. But we made some good moves, and then we had like another leg down, and finally the final leg in October for most stocks, in October of 2022. And of course, I couldn't be 100% sure that this was the final leg, and I never really said that it was, but we could tell that we were reaching some kind of bottom. I wasn't sure that it was like the long-term bottom that it turned out to be, but it definitely looked like at least an intermediate term bottom. So we went long a lot of stocks, and of course we had Nvidia trading at famously at like it hit like $108, so it hit my buy-in zone that we talked about for like a long time, the 120 to 100 buy-in zone. And then we had some tech stocks like Tesla bottom towards the end of the year at 100 famously. But we could pretty much tell from like some of the price action, like also in Facebook and Meta when it went below 90, and like in other stocks, in other tech stocks like Google when it went into like the 80 range, and Amazon. So we really saw like these stocks weren't around these levels for many years. And it wasn't like the banking crisis of 2008. So I mean, we weren't even really in a recession because the government kind of made it so we didn't see an official recession, although we did have a recession, like a very mild recession if you take like government spending out of it. So I mean, we just basically saw like a mild recession in towards the end of 2022. But many of these stocks just got oversold. Like again, it was like the reverse of what we saw at the end of 2021, where so many stocks got irrationally high. We saw the reverse of that, where many stocks got to irrationally low levels, especially in the tech sector. And we could kind of tell at that point that it was probably a good time to enter many long-term positions then, like Google below 100, like Google below 90, like Facebook around 80, Nvidia around 100, and AMD like around 50, and so on and so on. And I'm focusing most on the tech sector because it's my favorite sector, and we have like the brightest examples there, but it's not tech sector specific. It's basically the broad market bottom then. And we could tell that it was probably at least an intermediate term bottom based on the economy not being as bad as the stock market portrayed it to be.
Thank you so much. I think looking back in 2022, I think one lesson that we learned is that a lot of people still calling that a bear market rally, right? And they're saying the reversion of the value versus growth just get started. So a lot of people, in fact, still in the end of 2022, still very much piling into value stock, energy, or those, and those folks turn out to all to be wrong. But I think they're the majority view. So, so I think that seems like the market forecast is very difficult, as you can probably imagine. But but I think you probably made the right decision, on that, because a lot of people, I mean, I go back to a lot of videos recorded in 2022 by a lot of stock, gurus or those interviews. There's most of them still very negative. They think the economy is in the verge of collapsing, and we have to re-rate all the stocks because the PE is still extraordinarily high compared to the interest rate, and the value growth reversion just gets started. I mean, so
Right.
I think that's a lot of it kind of sees that it seems like you are much better in picking these. I mean, at least one thing to learn is to be not to be on a consensus view is always the best strategy, right? But but I just wanted, because I was going through some of the old videos, and that's the one thing that I pointed out is to learn from this experience, right? Yeah, I think.
Yes. And to address your comment, just to maybe there are so many I mean, that's what makes a market. There are so many views on the market. There are so many conflicting views on the market. and that's what makes a market basically. And yes, many people turned out to be perhaps incorrect in the sense that that the as you said, the revergence, or how did you mention it, from growth to value, it didn't really occur how many people envisioned it. And
Yeah, I think the growth outperformed value for last 10 years, right? So like, if you just 1 year reverting for 2022, a lot of people is calling for, another few more years at least. So I still very bearish on the growth stock, basically, even after the significant drop.
uh,
I mean,
one
I
thing,
guess you see it differently, right?
yeah. So one thing that I think it's very important to consider is that we never want to adopt a static view on the market, because the market changes all the time. The economy changes all the time, and market conditions changes all the time, change all the time. Market sentiment changes all the time. So of course, a person or a group of people that have a just stick to one position, say it's like a bearish position or whatever, and they say the economy is bad and the market's going to crash and the P's are too high, and et cetera. So basically, they're going against the market, and that's something that you never want to do. You never want to fight the market. You never want to fight the tape. You never want to fight the Fed. You want to go with the market, because you ride the waves with the market, and that's how you make money. So of course your viewpoint has to change. And some people, some critics, they say it's flip-flopping, and you go from being bullish to bearish, and you go from being bearish to bullish sometimes. But that's all nonsense, because basically you have to go from being bullish to bearish and bearish to bullish, because the market dynamics, they change all the time. And in 2021, I'm just going to use these examples because they're kind of the closest we have. At the end of 2021, so many people were bullish on the market, and that article that I wrote about the epic crash about to come, oh, I remember what it was called. It was called "The Drop is Coming and It Could Be Epic," and it was mainly about tech stocks and how they're likely going to decline significantly. And most of the commentary on that article were, you're crazy, Google's not gonna, or whatever, is not gonna decline by more than 10%. These are just gonna be healthy corrections. And probably these people ended up losing money. So I was bullish in when the years going up to that, and then I had to reassess the situation, and I had to adopt a bearish view, and I have no problem doing that, because again, the markets, they change all the time. The situation, it's always dynamic. It's always it's changing, and we need to be aware of this. We can't just take a forever bullish stance and kind of stick to it. And I think that's probably why some people were wrong in at the end of 2022, and many people were continued to be wrong throughout 2023, because they failed to change their view from bearish to bullish, which was required at the end of 2022 to make money in 2023. So that may be where that that disconnect occurs. I hope I answered your question.
Yeah. Thanks so much. Yeah, I think that's very, very, very helpful. Because help us understand how the market behavior. Thank you.
Yes.
What are you seeing in AMGN so much? That stock underperforming the healthcare basket is, I mean, ABV looks much better. Just curious, why AMGN? The quarter wasn't so well, guidance wasn't well. What's the reason for doubling down on that? And yet, and Tesla, I think, should be a bigger position in the portfolio. Go ahead.
Okay. So I mean that's interesting, and actually I agree with you completely. Tesla should be a bigger position in the portfolio, and I was actually considering about adding to the Tesla position,
Really,
and
I think
I will likely add around these levels because these are extremely attractive levels for Tesla right now, in my view. If we take a long-term perspective on the company, I think looking back 3 to 5 years from now at the $150 to $200 range, people are going to say, wow, that stock was cheap then. So that's definitely a great point on Tesla. About Amgen. So first, I want to say that I'm not like a deep expert on biotech or healthcare. Now, my reasoning for participating in the healthcare sector is because it was hated and beaten down so much recently that it likely has room to recover. Also, these stocks are cheap. Amgen too. Cheap relative to other stocks. So we see many healthcare names selling at like, P's of 8, 9, 10, a little bit higher in some cases, 12, 14. But still, these are relatively cheap, if we're comparing them to tech stocks or other areas in the market. Another reason is that healthcare should have in general, healthcare should have a robust earnings recovery this year. So some of these estimates could be lower than expected, and we may see multiple expansion in many of the stocks in the segment, not just Amgen and Pfizer and AbbVie, but others. I was looking at GSK recently and BMY. These are also very, very cheap. So that's my view. I think Amgen is a good company. It's a solid company, and I think it's a good mix of like a growth versus value play. I think it has more growth potential than like a Pfizer or a GlaxoSmithKline or like a BMY. So it has more growth potential than these stocks, and it's selling pretty cheaply here. So that's kind of why I like Amgen. I don't expect like the world from it. I don't expect it to go up, like incredibly high. But I think we can get this stock into like the 320, 350 range this year. And maybe, plus it has like a decent dividend. So I mean, that's why I like it. I like it from like a technical standpoint here, and I like it from this growth value perspective. And I understand that it's not like that the quarter wasn't great, but I don't think it was terrible. I don't think the guidance was awful. I think the company has potential, and as like one of the leading stocks in the sector, I think it can do well. But
got it, because the question was more of an from the sector. I used to own always ABBV and Merck. These were the two. I used to own LLY in the old days. I sold it at 650. Took more profits there. Maybe shouldn't have done it, but the point is, yeah, I never looked at Amgen as the one. When I picked in the healthcare, I would pick that one, but it's up to you. It's not up to me.
yeah, I mean, and again, going back to that, it's it's a thing. It's like a personal preference thing. We can we can use we can utilize Amgen to kind of have like a centerpiece as our of our healthcare basket, if you will, or whatever, like a Pfizer, or we can go with like an AbbVie, or it's really a personal preference. I can't say that Amgen is my main position here because it's like it's better than an AbbVie due to A, B, C, D. I'm not going to do that. Basically, it's just whatever your personal preference is to have as like a leading position in the healthcare segment. And of course, I'm not sure that Amgen will outperform some of these other stocks, but I do think that healthcare in general can do has potential to do well this year.
PayPal, you coming back in, or that one is out?
Okay, so let's get to maybe some more questions from someone else if they want to take the cue here. So while you guys are thinking, I do have
Could I ask a
yes, of course.
question?
Yes.
Hi, so my name is Chris. I live in Toronto.
I
The
can
name I
tell that
use
from
is
your name.
yeah,
And I've been to
yeah, yeah.
Toronto. It's an excellent city, and it's very nice. Niagara Falls there from that side. I've been on both sides. So I like it a lot.
It's kind of it's a good city to live for sure. Um, I just wanted to say honestly, like I mean, maybe just a quick background on myself, but
Yes.
so I used to work at I work at this company called AlphaWave in Toronto. It's a tech startup. There's a lot of AI actually in Toronto. So I'm like a 25-year engineer, pretty tapped into the industry. I would say AI and optics and stuff like that. I found your service through a friend at work, and like I've been on Seeking Alpha for a couple of years, and I just want to say your service is fantastic. I liked it so much I started to try other stuff because I just want more advice. I'd have to say honestly, your advice is like by far and away just it's golden. I mean, the other stuff there really is pretty hit and miss, honestly.
Thank
So
you.
I just like to compliment you, again, like on the awesome job that you do. It's truly phenomenal. Um, so yeah, thanks for that. I guess the question on the calls, I liked it a lot. I learned about calls for like 2 years, but I didn't have the kind of courage to pull the trigger on it till recently. And I do really like it. I like the concept you have, like where you sort of take advantage of the changing sentiment in the market, and you sell the calls at the peaks and you buy them back at the troughs. Uh, I guess the question is like why do you not just buy calls? Like why do you always sell covered calls? Like does that ever a thing that you consider to do?
Yeah, sure. And in I've I've bought, I've dealt with just buying calls in the past, and it's something that you know that I have done and we can do, and of course they can bring in much more alpha and much more quicker returns than just buying stocks or doing the covered call strategy. But I don't implement just buying calls, especially in the all weather portfolio, because it's a much riskier strategy. So of course, as we know, options they degrade with time. So a stock needs to move upward in a specific time frame for the calls to make money. So that's mainly why I stay away from the strategy, especially in the all weather portfolio, because I am working with all of you guys here, and I am kind of responsible in a way for, maybe not like I feel responsible in a way for the advice or the the suggestions that I give, because of course it comes down to people making or losing money, and there's a high degree of responsibility there. So
Hmm. Okay.
that's why I stay away from dealing with just plain call options. Another thing is that when we're dealing with the covered call strategy, we're basically, if we look at it from a perspective like a casino, we are the house. We have the stock. We create the options. We are literally creating the options, and we're just selling them. So we are the house. We can't lose. Now, most options in general, they expire worthless. So when we're buying calls, we are no longer the house. We are basically like in a casino playing. We are the players. So we need to be, there's a timing factor involved. So it's much more challenging basically to have this as part of like a very stable full-time strategy. Of course, in a bull market, we can make a lot of money with the calls, but it's just something that I don't do for several reasons that I just mentioned.
Okay, excellent.
And
Hey, Victor.
yeah.
I'm sorry.
No, go ahead, Ben.
Well, yeah, this is Ben. Hey, I appreciate you taking the time today and demystifying so much for us. Really appreciate that. And one thing I really enjoy is every day in the morning, you put out on the financial report a bunch of information telling us, this is where the market is, this is where the indices are. And then you put out some great information saying that, stop losses below this number are hedging over that number and that kind of information. What is your best tip for us on how to interpret that information? Obviously, you're taking actions later on, to do certain things with the portfolio. But for somebody who's learning the markets and trying to appreciate what's going on, what is the best way to take that information and distill it? And my second question, later on, if you can, is if you can say a couple of words about the ETF portfolio that you can get.
Sure.
Thank
Okay.
you.
So Ben and everyone, so basically there is of course a reasoning behind doing the daily market updates, and the primary reason for doing the daily updates is so we are, in a sense, first, so I'm connected with the group, and the group is connected with like the main elements in the market. Like I constantly do like the S&P, the Nasdaq, oil, gold, like silver, Bitcoin, and sometimes copper and some other some other major markets. So basically, the reasoning behind this is so that we are all connected, we are all on the same page in a sense. And of course, I want you guys to be as like clued in as much as possible and kind of connected to the markets in the best way. So that's the reasoning behind those daily reports and why I do it every single day. Now, as far as the levels, so I do the technical levels. Typically, I do like usually the breakout and the breakdown points. Now, this is also so we are as much as possible connected with the markets, because the critical support levels are the ones that we watch for potential like breakdown areas. Like, say, for now, like now we're watching we're watching several levels here in the futures market, right? So if I open the SPX, so right now today we discussed the 5200 level to the 5180 as the initial support, and that's right where the market is now. So the reason I mention these, of course, is for us to just to pay close attention to these levels, because they're very important for the general market. It's not just me watching these; it's investors and traders all around the world that watch these critical levels. Now, of course, when they break down, this means that stop losses get triggered. The algos can come in. We will see increased selling. Like if we see the 5180 level breakdown, we are likely going to see increased selling down to the next support area, which is around 5120 to roughly, like it's around 5100. So
Right.
yeah. So like if that breakdown occurs, we're going to see a slide down to 5,100. And then, you know, if we see the breakdown around 51 to 5150 or 50, we will test, and this is the critical level around 5,000. Now, so I mean that's basically the reason for talking about these, and we can also implement stops on individual positions around these levels because again, it's a personal preference thing. Some people will increase CCDs, like I'll typically increase CCD exposure. If this level, you know, if 5180 breaks down, some people can, you know, I'll likely decrease some riskier positions also. We can basically implement individual stops around some of these levels as well, because critical support levels in the general market, they typically coincide with some critical support levels in individual stocks. So if we want to trim some positions around these levels, you know, whether it's just from, you know, like a market sell order, or we put some stops around these levels on individual stocks, or, you know, whatever other positions, we can do that around these levels. And that's the reason for basically
emphasizing
those. I'm sorry, did you
Yeah,
have
that makes sense. That makes sense. Yeah, thank you so much. And tell us a little bit about the ETF portfolio that you created, and what is your ongoing strategy to maintain it, and how often are you going to make suggestions?
Yeah, so the ETF portfolio, it's much more passive. I'm not looking to make a lot of moves in that. That's basically a portfolio that just has ETFs, except for MSTR. That's basically the only like stock in that portfolio. But I use that as a proxy for Bitcoin, so it's the same, basically the same as an ETF. Now, the purpose of that portfolio is because many people look for ETF exposure, whether it's just to diversify, or to limit risk, or to just have you know, some ETFs in their portfolio. It doesn't matter. But the ETF portfolio gives people, and if you could just mute your mics for
Yeah, sure.
for while I'm answering, that would be great. So the ETF portfolio, it just gives people more options. Basically, I think the best way to use the ETF portfolio is to integrate parts of it into a broader portfolio. So you have some stocks, you have some ETFs in a segment. That makes sense in my view, because it limits the risk, plus it gives you some more diversified exposure. But the ETF portfolio, I'm not looking to actively manage that like I do the all-weather portfolio. I will make some adjustments in it, like quarterly, but it's not like I'm not gonna trade in it like every day.
Thank you so much. Yeah, I'm actually driving to the airport, so that's a little bit background noise. Sorry about that. But yeah, you just guys continue, and I really appreciate your time.
Okay, Ben. Thank you for your question.
Victor, can you share your insights on Bitcoin and where you think it's going to be at the end of the year, and why, and maybe some actions we should be considering?
Okay, sure. Yeah, and Bitcoin, it's a hot topic, and it's of course we've seen some remarkable gains recently, and then if we go back to like the bear market bottom around 15K, now it's it hit almost 75K recently, so we've had like a spectacular run. Excellent, great. I think it's a little overdone in the near term. So we just saw a 10% correction. I'm not convinced. I considered adding around there, but I'm not convinced that that it's done for now, and I just want to give it a little more time, because maybe Here we saw the 10%, but again, like that's the best case correction. And then we recently saw a 10% correction just a few days ago. So I'm not sure that we've seen all there is for now. The base case would be around 20% correction, so into the 62 to the 60K range. And then in like a worst case, we can see a 30% pullback, which would bring us all the way back to around the 50 to the 52K level. Now, I'm not sure that we're going to see that. That seems extreme, but again, that's like a worst case scenario. For now, we're looking at like possibly, you know, it ends here, but then again, maybe we see like a little deeper to around like the 60K range. Now, another element of like complexity here is the halving event. That's when, you know, it becomes more challenging, or twice as challenging or whatever to mine or produce the Bitcoins. So, you know, miners, basically it's going to be the rate at which Bitcoins are derived is going to be halved or whatever, so something like that. I'm not like a technical expert, but basically I think that's what it means. So of course, that makes Bitcoin, this element makes Bitcoin more valuable. And I'm sure most people are aware that there's only a set amount of Bitcoins, like 21 million, that can never be mined. And I think the estimated like last Bitcoin mining is sometime in like 100 years or something like that. That's how difficult like it's going to be to derive the Bitcoins by then. I'm not sure that you know that's like exactly how it's going to be, or like the exact trajectory, but you know, maybe roughly it's like around there. In any case, Bitcoin remains a popular asset, and whatever your critique of it may be, it is an alternative form of currency, or a form of storing your wealth, like on the internet or in your personal like cold wallet. So it is a coveted asset. So of course I am not I do not agree with the people who say that Bitcoin is worthless, or it's, you know, it should be worth a lot less. I don't agree with this. I think that Bitcoin should be worth a lot more, and I think it's heading there. I think it's gonna go much higher. I don't know if it will happen, you know, this year, but technically, I believe Bitcoin should be worth like around $1 million a Bitcoin, and it could happen by 2030 or maybe 2035. I don't know when, but I think it should be worth like that much. Right now it's at 75,000, or right now it's at 60, like whatever, around 68, 69,000. So again, we're talking about this near term relative to the intermediate and long-term dynamic. So to pinpoint Bitcoin's, you know, Bitcoin, it's a volatile asset. To pinpoint its price point in the short term, it's very challenging. But you know, we try to do the best we can. That's why I give you the ranges of the 10%, 20%, and worst case 30% pullback, like in the near term, is what we could see. As far as this year, my best estimate, maybe Bitcoin already made an all-time high. So we talked about that earlier in the year and last year, and Bitcoin already made the all-time high. How much higher is it going to go this year? Maybe it's 100,000, maybe it's 120, or in a bullish case, maybe it's like 150,000. It's possible that Bitcoin goes to 150,000 this year, or maybe sometime in 2025. My rough estimate for the next peak, or you know, like the next Bitcoin long-term peak, meaning that we will have like a considerable bear market afterwards, is around roughly 150,000. So I mean, that's where I think Bitcoin is going in the intermediate term, before it hits another, you know, like before it has another 75-80% drawdown, and then the next bull cycle will begin. And you know, it's we can have like many more waves until we get to the ultimate, you know, whatever, like high price of Bitcoin, where maybe it will stabilize and be stable for some time.
So then if you extend that out and say, do you purchase Bitcoin or do you continue to invest in a MicroStrategy as an example on a pullback?
Mhm.
What are the advantages of saying going down the MicroStrategy route?
So MicroStrategy route, it's an interesting route. But it's a route that you must be prepared for to be very volatile. The reason for this is because it's a stock. It is not a Bitcoin ETF. It is a company. It's a stock, and there's the stock market irrational element that we need to consider. What I mean by this is that if we look at MicroStrategy now, it trades at about a 100% premium to the Bitcoins that it has. So basically, it's 100% overvalued now. So it's valued at twice at what its true value is. So there is an underlying value to MicroStrategy, and it's very simple. It's basically it should be valued as much, or basically its value is what its Bitcoin stockpile is worth, which the company owns around 200,000 Bitcoins now. And at, you know, around 70,000 worth of Bitcoins, you know, each Bitcoin is worth 70,000. So it should be worth around 14 billion now. Because it's software business, it's really nothing relative to what its Bitcoins are worth. So its software business may be worth like 2 billion. So that roughly cancels, maybe slightly more, maybe slightly less. Average estimate is around 2 billion for its software business. So it's, you know, maybe it's even worth less than that. So it's largely irrelevant. And the debt that the company has on its books basically cancels out the value of its software business, and the debt, they kind of cancel each other out. So we're basically looking at the Bitcoins on its books, and we see that it should be worth around 14 billion. The stock's trading at 28 billion, the company. So we see a huge like irrational factor here. So I am against owning MicroStrategy now. I was for owning it when it was around, you know, when there was no premium, or it got inverted a little bit, like recently around like $500 or 600. So of course, here's when you want to own MicroStrategy, when there is no premium or it gets inverted. And now when it's double and it's, you know, it's trading at an irrational level, I don't think it's wise to own it now, unless of course Bitcoin. I don't think it's wise at all, but Bitcoin could, you know, break through 75,000 and go much higher. MicroStrategy would go higher than 2, but it's not based on the underlying value of the company or the Bitcoin it owns. It's basically just the market being irrational, and people just bidding the stock up. And then there's a short squeeze element that's involved. So that's where I stand on MicroStrategy. And Bitcoin, I would much rather own Bitcoin here than MicroStrategy. And if Bitcoin, you know, if Bitcoin's correction intensifies and it falls through the floor for whatever reason for a period of time, MicroStrategy stock can decline by much more than the Bitcoin declines.
Cool.
So
Thank you.
if Bitcoin drops by like 20% from here, we can probably count on a 50% decline in MicroStrategy or more.
So do you expect to change all of their portfolio away from MicroStrategy to like a Bitcoin ETF instead?
I don't plan on purchasing a Bitcoin ETF because I can basically just purchase Bitcoin. I plan on repurchasing right now. The only MSTR positions left in the portfolio, they're under CCD, and so they're not making any money, or you know, the price is it's basically I would like to buy these CCDs back, but of course I'm not going to buy them back now. But if we see like a considerable decline in the near term, I would buy them back, sure. And then by then, likely the premium in the MicroStrategy stock would be much less than it is now. So at a 100% premium, I have no interest in owning MicroStrategy.
So on the flip side of that, so if you're looking at MicroStrategy falling and you're expecting it to fall, would you look at buying an in-the-money call with the sense to buy it, to sell it and then to buy it back later?
You mean an out of the money call?
So sorry. So for instance, so you're the premium now of MicroStrategy. So the idea is if you've got a if you're in money call, so right now you've got a higher premium, and the idea is you're hoping that's going to fall back later, especially with the expected pullback in Bitcoin. If I'm, obviously I'm apologize, I'm quite new to this, but what I'm looking at, for what you're suggesting is that MicroStrategy might actually pull back, and there's a good chance of that happening. Is there a way through selling a CCD at a very high premium for a strike price that's below the current price, and then expecting that fall and purchasing it back later?
I don't deal with CCD within the money CCDs, so when I do a CCD, but I mean, yeah, that does make sense. I don't typically do that. That's not the route that I usually go, but in this particular case, that makes sense. So that is something that we could do.
Okay, and then so second part to this one.
Yes.
Are you looking at downside possibilities happening? Are you looking at buying some puts just to offset the risk on that, hedging there?
We could do that again. That goes back to like the call put option thing. I don't implement that in the all weather portfolio because that would put another layer of complexity in the portfolio, as well as the factor that just general put option strategy is a risky strategy. But in this particular case, in MicroStrategy's case, I think if you believe Bitcoin is not gonna blow past 75,000 here, then buying some puts on MicroStrategy stock makes sense. But then again, I just want everyone to be cautious here, because Bitcoin is very unpredictable, and it could rebound here, go above 72K, and then proceed higher, which would make MicroStrategy's stock behave possibly more irrationally and move even higher from here.
So Victor, if this is Todd from Dallas, so if you have MicroStrategy, but you don't have a covered call on it, just given that some of us may not have it because of the price of the stock itself, you would probably recommend going ahead and selling here. It sounds like, just given the huge premium on it, right?
Yeah.
Okay.
I just wanna clarify this, that the MicroStrategy position in the all weather portfolio, or my MicroStrategy position, it's at a much lower. I mean, it has like I have 2 CCDs left. I sold the remaining of my position at around 1,300. Now, from my positions from before, I have one with a CCD at 1,000, and I have one with a CCD at 1110. So I mean, that's quite a bit lower from here. So I mean, my MicroStrategy. So that's basically the same as saying that if my MicroStrategy stock falls back to 1,000, that's not going to affect my portfolio.
Yeah, because you're fully covered on it. I'm with you.
Yeah, I'm fully hedged on MicroStrategy here, and I think unless you're expecting like a huge breakout in Bitcoin from here, which may or may not happen, I would consider taking at least some profits on your MicroStrategy stock because it looks pretty, it's pretty overvalued here.
Yeah, and then for the ETFs around the Bitcoin, if you don't want to deal with the coin itself through the houses and stuff, which ETFs do you recommend? I've got Grayscale, but I know the fees on it are high, and I'm wondering if that's the one you'd still recommend or different ones.
I do like Grayscale, but I think we can also go with BITO. BITO. It's actually it's not a physically backed. It's ETF. It's a Bitcoin futures ETF, but I think it's good because it's highly liquid, and there's a lot of volume on it. So I kind of like the GBTC and the BITO ETFs.
So you don't have a problem paying the fee then on the GBTC for some portion of Bitcoin. Then it sounds like.
I don't. I think it's the biggest. It's the best. They have. It's the only ETF that's bigger than MicroStrategy. Their stockpile is huge, so I like GBTC. I also like their Ether ETF.
Yeah, I've got that too. Thanks.
Would you sell the MicroStrategy in the ETF portfolio?
That is a good question, and I've been looking at that, and I may take some profits in that one, at least a partial around here. But again, I'm kind of looking for the cue from Bitcoin here that it may go lower, because I mean this MicroStrategy stock, it's wild. It's like nothing I've seen in a very long time. I remember GBTC when it could float around like that. It also traded at about like 100% premium at one point, which was pretty crazy, but that was like a long time ago. I think that was in 2018 or something like that, or 17.
I think just want to chime in. I think there's I share Bitcoin ETF, which is probably the most the lower fee alternative to GBTC. I think people prefer. I think most of people who withdraw money from GBTC actually went to that 0.2% management fee. I mean, I think for the MicroStrategy, probably one of the reasons is that people still believe they always gonna be issuing debt and piling into Bitcoin. So that's the kind of consistent, pushing to Bitcoin. So if you are ultra Bitcoin bull, I think maybe that's they've been consistent doing that. Maybe that's explained the premium, but I don't know any other product, but yeah. All right.
Cool. Thank you.
Hey Victor, could you give some or talk to a bit like your strategy for looking for good call options or good CCDs? Like what kind of things you look for?
Yeah. So basically we want something that's high yielding. So by high yielding, I mean like at least 4 to 5% in a like a 4 to 6 week time frame. So we want to get a nice premium of at least 4 to 5% in a relatively short time frame. Now we also want a stock that is probably going to trade sideways or lower through that period. We don't want a stock that's that's likely to continue higher, because obviously we would make more money just holding the stock. So these are several of the elements. We also want a company that is relatively stable, and we don't want to own anything too risky, because that could of course complicate things. So I mean these are just like the basic elements that I look for. It's nothing It's nothing like too crazy. And I do like a list of stocks. Usually once a month I release a CCD plan list, and these are just like the basic stocks that I followed and I cover for like many years that have relatively high CCDs, and most of them are in the tech sector, but we have some, like a few Chinese stocks and some you know, some material names, and just to diversify things. But most of these stocks are going to come from the tech sector, and because this is where the volatility is, and that's where you're going to find the best premiums around. Yes, next question.
Hey, Victor, what is your take on gold or gold miners at these levels?
Gold mining. So I'm bullish on gold, of course, intermediate and long term. We've come along kind of a long way in gold here. So we've like recently, basically. But I still think there's a lot more potential in gold. So the problem with gold is that the market really doesn't like gold too much. It's not a fashionable asset. It's not something that the market sees as like an asset that can bring really good returns. We've had mixed returns recently in gold. So it's basically gone, like some people will say it's gone nowhere during the last decade. But I would encourage people to take like a longer term perspective on gold and kind of look through the history and the longer term trends, and then we will see that like a prolonged period of non-performance in gold typically leads to a prolonged period of outperformance in gold. And that's, you know, also we should consider the Fed's likely pivot towards an easing cycle, and also the probability of future QE and more monetary expansion. So all these elements kind of lead to a really constructive fundamental backdrop for gold and silver. I would say particularly. Now we can kind of tie this back into the 2007, 2008, like 9, 10, 11 period, where we really saw a huge takeoff in gold and silver prices. Now, I was actively trading gold and silver then, and gold went from around 700 to like around 1900 or whatever in a short time frame. But silver really shined because it went from like $11 to something like 10 to like over 50, and I think like around 2 years. So we really had an explosive surge in prices in a short time frame. And the gold miners, they did really well. They even outperformed. So typically in a bull market, we can see gold miners you know, maybe do like a 3x relative to gold. In like really bullish periods, we can even see them like a 3 to 5x outperformance over gold. So if we're talking about gold miners. Now, we haven't seen that recently because, again, the market is very down on gold, and it's down on gold miners. And recent reports from the gold miners, they weren't great because we see some efficiency issues, and basically there's a lot of optimization to be done. They're not as profitable as they should be. The management, you know, is not as good as it should be. So there are some company specific problems here, especially in Newmont. We saw some issues. So that's probably why we're not seeing the type of outperformance in gold miners that we would like to see, or we would expect to see with gold like around all-time highs. Now, that's not to say that this can't change or this won't change, because the probability is that it will change. And that, you know, if gold goes on to like 2,500 this year, we could probably see some significant outperformance in many of the gold mining stocks. So that's kind of where I am with gold. I'm not very happy with the way that that the gold miners have performed, but I think that we can see improvements there, and I think we can see the market, especially if gold goes to new all-time highs, we can probably see the market kind of rush into some of these gold mining stocks, and the market could push them a lot higher.
Okay, thanks. And one more question. Do you suggest implementing cash covered put or options, especially with the chip stocks? Thinking about the buying
yes.
ranges that you mentioned in your recent
Yes,
article, do you
absolutely.
recommend implementing?
Absolutely. I would, that's one of the primary reasons why I typically provide like, buy-in ranges. When I write about especially like chip and tech stocks, because these are the levels that we can focus on to sell our cash covered puts. These are the levels that we want to own the stocks. These are the levels that we want to buy into the stocks. So why not get a premium for waiting for these stocks to fall into these buy-in zones? It makes perfect sense, and it makes for an excellent strategy.
Awesome. Thank you.
Okay, so we have a lot of people in here. Who else has a question?
Hey, Victor, it's Michael Sanchez.
Hey,
I have a gold related question. So I pinged you about this quite a while ago that I had sold my physical gold and silver holdings. And yet I noticed AWP had, positions that were physical. And at the time you were like, well, you could buy Barrick Gold or SLV. So that's what I did. And Barrick really lagged, like my physical metal GSM segment was always lagging the AWP because Barrick Gold wasn't doing that great. So I was talking to G Power and he's like, so I wonder why I didn't mention CEF, because that's what I do, because I don't have physical gold or silver either. But the problem now is that Barrick has recovered some. So my question to you is like, I basically have 2.5% of Barrick Gold in addition to what AWP has, because I'm compensating for not having the 2.5% in physical gold that AWP has. So I'm wondering at this point, does it make sense for me to sell 2.5% of the 2.5% position of my Barrick and put that in CEF? Or at this point, just leave it with an outsized, I have almost 6% position in Barrick.
Okay, good
Do you think I
question.
should leave it?
Yeah.
Some of that to see.
Gotcha.
Sorry, I have a.
No, it's fine. I think that's a big position to have in just one gold company. Although Barrick is among my favorite gold miners, I think it's a very significant position. I would consider breaking it up, possibly between gold, AEM, and maybe like a KGC or an AGI or something like that. These are also good gold mining stocks. I don't think that it's necessary to own like physical or ETF form gold or silver. You can if you want, and again, this is good for diversification because like you never know what the market's going to give you. Again, typically in prior bull markets, like I saw gold mining stocks just outperforming significantly, like 3 to 5x in some cases. Now they're lagging. So it's like go figure what the gold markets is gonna give you. So from this perspective, it's better to be diversified, have a little physical, and that's what the all-weather portfolio does. It has a little physical, or whatever. ETF form it's basically like the same thing. Of course, there are some advantages and disadvantages to both. But I would encourage some diversification between like the physical ETF form, gold and silver, and some of the high quality gold and silver companies, and probably better not to just have it in just one company, but possibly split the position among 3 companies. And also PAAS PAS is an excellent option because it's the largest silver miner. Plus, they recently purchased Yamana Gold, which is quite a good gold asset in my view. So, and they also have copper exposure, so you get like the best of both or all worlds with PAS. I like that one a lot.
Yeah, I'm pretty much matching the AWP. The difference was I was taking not all, but some of the 2.6 physical gold position. And that's represented in Barrick Gold for me. So I have like a 4.5% position, cumulative positions in Barrick Gold, and AWP only has a little bit over 3%. So it's still, I'm matching on the rest. So I have KGC, AEM, PAS, LP, right? So I have diversified, but I just have a really overweight, not as bad as I thought. I just looked at it. I think it's 4.6%. So it's not 6%, but
no,
it's
that's not too bad then. That's it. I misunderstood you then. So if you have those other stocks and it's kind of like just as a part of a more diversified gold basket, then that's better in my view.
Yeah, I'm just much heavier on Barrick than AWP is. So I was wondering, but I
don't think that's a problem. I don't think that's a big problem because it's one of the top companies, and I think it's really underappreciated, maybe probably undervalued here. So
trade out of it because it's already dipped.
It could do well.
Yeah.
I don't think that's bad. Good.
Okay, I'll just hold it then.
Okay.
All right.
So let me jump in. This is Vasily. If you were to rebalance your portfolio from scratch, what would be the most significant changes? Or maybe you're just happy with the way it is?
So, that is a good question. And I am pretty content with the way the portfolio is. But here I would increase some positions for sure, and I can tell you that I would increase Tesla around here. I would also look to increase Google around here. I think it's quite underappreciated. I would also include Meta, Facebook. I think that's an excellent stock to own in the future. So I would do some adjusting there. As far as like the rest, I'm pretty content with the makeup at this point. So yeah, I would definitely look at that. Perhaps increase some oil exposure here, and I'm a little split on the alternative energy side because we've had some mixed reports recently, and then really mixed success in alternative energy. I am a believer long term, but I'm a little concerned about the opportunity cost in alternative energy. So that's another area I would focus on. The rest of the portfolio, I think it looks pretty solid here. So these lithium stocks have been just obliterated recently, but I mean, really looking ahead, we could see higher, lithium prices increasing because the glut it will pass, and of course EV demand should increase. So I really think this we we should consider this segment like for the long term here. So we're seeing a lot of movement in LAC recently because they have the huge project that just got the loan approved, so that stock has the potential for a lot of upside ahead, in my view.
Okay, adding in terms of the portfolio rebalancing seems sort of question thing. I think a number of us are still adding funds to our portfolios. So are we looking at a cost dollar average approach where we just spread it throughout the entire AWP, or are we looking, say, for instance, Tesla's down quite a bit, start focusing more on Tesla, even though it's going to unbalance our portfolios in comparison to AWP? What do you recommend?
Yeah, so I mean, again, I think it's a personal preference thing. I don't think that everyone's portfolio should be like 100% the same, or like, reflect the AWP like exactly. I mean, it could, but if there are some if there are some like variations, or if there are other core positions, I think that's also fine. And speaking of core positions, I think we should focus, we should probably focus on those, the AWP's core positions, and of course we can have individual cores. It's not like the AWP has all the best stocks in the world. It does not. It has obviously some of the highest quality companies in the world, but there are others. So I mean, those can be like core positions in your portfolio, and then basically we just want to build around the cores with some secondary positions that are a little bit higher risk reward, and that may not be as high quality or as established as the core positions, but they provide diversification, and they provide more potential for for gains ahead. So that's basically where I stand on that.
Okay, I just out of curiosity, your Polanta stance of nearly 12%, which is obviously quite a big, in comparison to other cores, is quite sizable. Why is that?
Oh, concerning Palantir?
Yeah, so in terms of your core companies, it's something head and shoulders above the rest.
I understand.
So
that's basically, that reflects my my intermediate and long-term bullishness on Palantir particularly. The reasoning behind this is because many market participants possibly misunderstand Palantir. Many market participants possibly misunderstand exactly what the company does or what it can do. And for these reasons, many market participants, they may underestimate Palantir's potential in the long term, which is why the stock remains, in my view, underappreciated by the market, especially if we are considering it for the long term. Palantir is the single most company that reminds me of Tesla, maybe around 10 years ago. It is a battleground stock, and I think it has, out of the core positions, I think it is the stock that has the most potential in the intermediate and long term for the next 5 or 10 year period. So I think that's a pretty good reason to have it as the most significant position in the all-weather portfolio. And if you want me to give you the reasoning why, I can. So basically, Palantir offers optimization, an optimization platform, optimization software, software which is backed and powered by AI. which can really serve any company or institution, government or private, in any industry globally, regardless of its segment. So the market the market potential for Palantir, it's massive, and the growth potential for the company remains exceptional at this point. Also, if we look at the recent reports from Palantir, we see that its commercial side, which is where the real the real potential is, the commercial side of its business is expanding rapidly, and we could see this this continue or even accelerate in the future, which makes Palantir a truly a unique stock in my view.
Do you still recommend adding Palantir at this level?
Do I think Palantir is a good buy at this level? Yes, I do.
Yeah.
I think Palantir is an excellent buy at this level, but I think if we are patient and we wait a little bit, we may be able to pick up Palantir around $22 or even in the $20 to $22 range. So that would be even better than buying it at $23.75, where it's trading at now. But I don't see a problem with initiating a position here or even adding to a long-term Palantir position at this level. And again, it's all about the market, and it's all about sentiment. So I mean, we could see Palantir decline, you know, in the near term to 2022, possibly even lower. If we have a broad market correction, we could have a bigger decline in Palantir, but that doesn't really take away from the company's long-term perspective and from its potential long-term.
Thank you.
Victor, one question on Tesla.
Yes.
So how low you think it can go? Like I see some articles claiming that it's going back to $120 soon. So just wondering what is your take on it?
So the thing about Tesla is that it's a truly the battleground stock, the most battleground stock that I've ever seen or participated in. Like the people that are or were against Tesla back around like the 2017-18 timeframe, you know, they all said that Tesla, or many of them said that Tesla would fail. There were, you know, that the Model 3 would fail, that there's no demand, that, you know, I mean, obviously this all turned out to be incorrect, or yeah, basically it turned out to be incorrect or misleading, but the Tesla remains a huge battleground stock, and many people hate it for various reasons, whether it's that they lost money on it in the past, or whether it's their products or what. So, but again, it's a market, so it could take Tesla lower. I don't think Tesla is going to see $100 ever again. That's my personal view on it. I think that was a generational low. Tesla could possibly, you know, decline. I mean, it could decline to 150 in the near term. Could it go marginally below 150? Of course, we could see Tesla in the 140, 150 range. But I don't think that Tesla is ever gonna. I don't think it's gonna see $100 again, or the 120, $100 range. That also seems extreme. But if we do have a considerable correction from here, we could see Tesla possibly go below 150, test the 140, 150 range. That's also possible. But we have quite a solid support level at 150, and I think a lot of buyers are going to come in around the if Tesla declines into the 150, 140 range. There is a gap there that could get filled. So it is possible that we see a retracement to around the 150, possibly as low as 140. The gap, it's actually slightly below 150, so 140. Maybe if there's an overshoot to the downside, maybe 140. But I would really, be aggressively buying Tesla if it gets down into the below 150.
Oh, thank you. Thanks for the valuable insights.
You're welcome.
Yeah, maybe if I can jump in, I'm holding a Tesla puts, which I've been holding since it was 240 or something like that, and they have not been called yet. So if somebody, so this is not about me, if somebody knows what they're doing, I'll wait until they get called away, because that's when those people expect the bottom of the decline. That's
Okay.
an interesting experience.
Yeah, I mean, and of course, it's again, it's a market, and the options market, it's even crazier than the stock market. So, I mean, good for you though with the puts.
No, I sold it actually.
Oh, okay. What strike price were you?
220.
220. Okay.
So they haven't been exercised yet. So whoever is holding it is thinking that it might go lower.
Of course, and that's usually what the people who buy the puts think, and they're betting against the stock. And Tesla goes through the stages, and now it's really not a favorable stage sentiment wise, which is, and of course, sentiment is what impacts price in the short term. So recently, it's not been a good phase, because we have several negative short-term factors. We have the slowdown in the EV market, like generally. We have high interest rates. We have a relatively slow economy, which is typically not good for, and we have low oil prices, relatively low oil prices. So, I mean, this is typically not a great environment for Tesla. But again, these are short-term dynamics that should change. I mean, they will likely change, and will become much better for Tesla in the intermediate and long term. So whoever's buying the puts, I mean, obviously they're making money, and they're doing a good job, because they are correct on the stock in the short term. But again, how long that's going to last, we'll see.
Okay, thanks.
What's your threat for Tesla regarding the Chinese manufacturers, or you regard Tesla more as an energy company rather than an auto company?
Yeah, I'm one of the guys who looks at Tesla more of like a generally like a tech company that just it's like a tech/auto company. Of course, their most significant segment by far right now, it's vehicles. Whether that will be whether that will remain their most significant segment forever is questionable, just because they have so much potential in AI, robotics, and self-driving. There's a whole debate on the quote robo taxis, like in the future, and how much money Tesla will make with that. But I think I definitely think it's much more than just an auto company. And when comparing it with the Chinese automakers, I think it's very different. It's a very different company than, like, say, BYD, because BYD, it's really like economical, sort of cheap Chinese vehicles that they're doing well, because there's so many people in China. It's such a huge market, and so many people in China are buying these kind of cheap Chinese BYD vehicles. I'm not saying that BYD is a bad company. It's done exceptionally well, but it's certainly not Tesla in my view. The closest company to Tesla, I think, is NIO, because their vehicles are relatively luxurious, and it just it reminds me of Tesla, but of course they're nowhere nearly as profitable, and NIO is just a whole separate story with many issues of its own. But as far as the cohesive, like the whole comprehensive image related to China and the global market, I think people may underestimate just how big the auto market, the EV auto market segment is going to be in the future, because ICE vehicles, really, it's an inferior technology, like any way you cut it. Right now, we're seeing like a resurgence of ICE relative to EVs, but I think this is temporary. And there are many reasons for this. It's just EVs, they're more economical, more friendly for the environment. Many governments, including the biggest car market, China, they have phase out plans where ICE vehicles will no longer be sold after like a certain time frame. Some of these time frames are relatively soon, like 2030, 2035. I mean, that may seem like in a long time, but time flies. So the EV segment, it is the future, and successful investing is betting on the future. So really successful investing is betting on the best companies that are going to do best in the future. So my money is on Tesla.
Thank you.
You're welcome. Okay, time for maybe another question.
I'll go.
Okay.
So with regards to EV in the future, like I'm in California, we can't even run our appliances between 5 and 9 p.m. without paying exorbitant rates. How are we supposed to charge these vehicles? I mean, there's such an incongruency. And move to EV. I've got the Dodge Ram dealer who won't even let his wife buy a Tesla. I mean, they're beautiful cars. Don't get me wrong. I love them. I've driven one. I'd love to own one, but it doesn't fit with our current level of infrastructure in place across the country, and even just basic rates to run our houses.
Good question. Excellent question. And I think that this is also part of the kind of like the transitory, temporary issue that's surrounding the EV industry and the alternative energy industry, and basically this whole transitional process from kind of like the old world, electrical grid, oil and gas, to the new world, like EV, solar, and other alternative energies, like powering everything ahead of us, around us. This is not a process that that happens smoothly and over a short time frame. This is something that is, I guess you can call it, revolutionary, and it's going to take time, and there's going to be periods of inconvenience, and periods of like we're seeing now, and like you're describing, of the higher than anticipated costs, and this may illustrate this kind of I guess, like I said before, this transitory phase. How exactly it gets this problem gets relieved, it remains to be seen, but I imagine there's, and again, I'm not like a super expert on the energy grid or anything like this. But I suspect that, you know, there's going to be other innovations, government sponsored programs to
Oh,
optimize.
no. The Governor Newsom, he's decided to tax your electricity bill based on your income. That's his latest proposal.
Yeah, and
How to
again,
get out of
yeah,
it.
and again, that's just like craziness that's associated. That's maybe like that's political. That's not something that could be sustainable in the long term. I mean, governors, they come and go, and that seems you know, a lot of the things going on in California, they say California is like its own little country, government, call it whatever. But you know, and I'm not an expert on California, and I have nothing against California, but I think that some of the things that occur within like the government there, that's associated with like, you know, the EV industry and energy, I think maybe it's a little crazy, and
Yes, it is.
and maybe it's unsustainable, and
It
perhaps
I'm sorry, from my side of things, I live in Dubai, and from a geographical perspective, I have a Tesla,
yes,
and actually in a place where oil is so cheap, it's actually cheaper for me to run my Tesla in Dubai than it is an ICE car. So I'm on the flip side of things.
Wow.
yeah. So there you go. It's there are different dynamics all around the world, but California is a huge market, of course, for Tesla and EVs, and honestly, I think what's happening there with the politics, it's unfortunate what's happening there with the politics and what you're describing here. So, guys,
Can I follow back to Palantir real quick?
yes.
Okay, so with Palantir, I've always associated it with like defense, like they are like in working real time for our country to defend itself or help Israel or help Ukraine and all that. So what I heard from you is that it can be applied to any industry, you know, in the world, basically.
Exactly. Any segment, any company, any industry in the world, which is what makes Palantir so amazing. And yes, it has a defense segment. It's a significant defense segment. They work with the U.S. government very closely, and with
Can you
friendly
give a non-government
government.
example?
Yeah, of course. They have Palantir has many companies that it works with, and
Like a hospital, what would they do for a hospital?
they would optimize its systems. They would make it so all of its systems and processes would be more in sync with one another. They would make it so basically its operations would work better, would be optimized, and would in the end make the organization more profitable.
I guess the follow-up on I forgot to ask there, their moat in comparison to other companies also running AI, how do they
provide the whole package? Basically, some companies can offer like partial capabilities that Palantir can provide, but as far as I know, there's no company that can provide the whole package, the whole spectrum of a platform supported by Palantir's services to provide the comprehensive solutions, basically all in one, like Palantir does. Guys, It's 6 o'clock on my end, and so we've gone over the 2-hour limit now.
All right.
Thank you
Thank
everyone for joining. Thank you for all the questions. It's been a pleasure as always to speak with everyone. I am recording this, so I will post it ASAP in our group. I appreciate everyone. You guys are the best. I do this to help everyone in our group. Main objective is to make everyone better investors. Thank you for joining me.
Thanks so much.
Thank you
man.
so much. Yes.
Thank you very much.
Thank
Okay.
you.
Bye bye everyone.
Thank you.
Bye-bye.
Bye.